Welcome to the deep dive. Today we're jumping straight into the sources for a really interesting company. It's one sitting right up this kind of wild intersection of Bitcoin, AI, infrastructure demand, and the challenges facing the electric grid. We're talking about CleanSpark Inc. Ticker is CLSK. And our mission for this deep dive really boils down to one core question. Are they just a Bitcoin miner? Or could CleanSpark actually become something bigger, maybe a new kind of digital utility? Now, I'll tell you right off the bat, looking through the sources, it's definitely not simple. CLSK seems to be what you'd call a fundamental battleground stock. You've got this, industry-leading operational efficiency, which is genuinely impressive, right? A real advantage. But that strength is constantly wrestling with this massive, almost existential dependency on one single asset. And that asset is, notoriously volatile: Bitcoin.
Exactly. That tension. That's really the heart of the story here. You absolutely need to grasp that conflict. And just for context, everything we're discussing, all the data, it's anchored to the market close on October 9, 2025. The stock closed at $19.31 per share that day. We're going to use our usual structured approach, breaking down the company piece by piece, from the tech to the market sentiment.
Okay, let's start there. Part 1, the core fundamentals. Chapter 1. Business analysis. So let's unpack the basic business model first. What exactly does CleanSpark do?
Well, at its core, it's elegantly simple, actually. They take low-cost electricity, lots of it, and they transform it into Bitcoin. They do this using specialized computers, ASICs, housed in data centers they own and operate right here in the U.S. These machines work to secure the Bitcoin network, and for that work, they earn rewards. Currently, that's 3.125 Bitcoin for each block they successfully mine. That's the post-2024 halving rate.
And they're not small players in this game. They call themselves America's Bitcoin miner, which, sounds like branding, but the scale backs it up. As of September 2025, they were actually the first publicly traded miner to hit an operational hash rate of 50 exahashes per second. That's 50 EHs.
Right, and the 50 EHs is a huge number. It puts them firmly in the top tier. You mentioned competitors earlier, like Riot Platforms is around 36.5 EHs, while Marathon Digital is closer to 60.4 EHs. So CleanSpark is right there, a major player.
And they built up a significant Bitcoin treasury too, right? Over 13,000 BTC.
Yes, over 13,000 Bitcoin held. That's a substantial asset on their balance sheet. But, getting back to the operations, especially after the halving event reduced the mining reward, efficiency is just paramount now. It's the key to survival, really. And this is where CleanSpark stands out. They boast an industry-leading fleet efficiency of 16.07 joules per terahash, or JTH.
Okay, 16.07 JTH. Help us understand that number. Why is it so important?
Think of it like fuel efficiency for a car. Miles per gallon, right? Lower is better. A lower JTH means you use less electricity to perform the same amount of computational work to mine the same amount of Bitcoin. And when electricity can be 90% of your direct operating cost, that difference is huge. Compare their 16.07 to Riot Platforms, for instance, who are running around 20.5 JTH, according to the sources. That gap, that's a massive competitive advantage. It's a moat.
Got it. So efficiency leader. But there's this other angle emerging, this AI pivot. They talk about an infrastructure-first strategy. How seriously should we take this? Is it a real diversification play or just, latching on to AI buzzword?
Oh, it seems very real and potentially crucial for that digital utility idea you mentioned earlier. Look, they've already built the hard stuff. They have the massive power contracts, hundreds of megawatts secured. They have the industrial cooling, the physical security, the buildings. That same infrastructure is perfectly suited for high-performance computing, HPC, and AI workloads, which are, as we know, incredibly power hungry. So leveraging those sunk costs, that owned infrastructure, for a completely different non-crypto revenue stream, that's smart. It's a hedge against Bitcoin's volatility. It makes total sense.
And this is happening against a backdrop of huge institutional demand for Bitcoin itself, right?
Okay.
The ETFs launched by BlackRock and others.
Absolutely. The sources highlighted that in 2025, institutions bought something like 7.4 times the total amount of new Bitcoin that was mined. That underlying demand is a significant tailwind for the whole sector.
Okay, competitive landscape.
Yep.
We mentioned Riot and Marathon. So CLSK sits comfortably among the top miners by hash rates. Anything else on competition before we move on?
Just that it's fierce. Hash rate isn't static. Everyone is constantly upgrading machines and expanding facilities. So that efficiency edge CleanSpark has, they need to maintain it.
Makes sense. Just a quick aside here for our listeners. If you're finding this analysis useful, do consider liking and subscribing to the stockanalytics.ai YouTube channel. It helps us out.
Yeah.
Okay, let's move to Chapter 2, Management Evaluation. Who is steering the ship through all this volatility and strategic pivoting?
Well, there was a bit of a shakeup, or maybe more an evolution, in the C-suite around August and September 2025. It looks like they focused on promoting internal talent, as Matthew Schultz became CEO. And Gary A. Vecchiarelli, who was already key, took on a dual role as president and CFO.
Promoting from within. That usually signals stability, right? Continuity
Yeah.
and strategy.
It suggests confidence in the team and the path they were already on during that major growth phase.
Now, one really interesting strategic shift was in how they manage their mined Bitcoin. You mentioned the treasury.
Right. Historically, many miners just held on to almost everything they mined. HO dealing, as they say. But that makes you incredibly exposed to price crashes. CleanSpark made a change starting around April 2025. They began selling a portion of their monthly Bitcoin production
Why is that significant?
because it allows them to self-fund their operations and growth initiatives using those sales. It means less reliance on potentially diluting shareholders by issuing more stock just to raise cash for electricity bills or new machines. It addresses a big investor concern.
Okay, that sounds like a mature move. Speaking of maturity, the sources also mentioned a pretty large share buyback program, $145 million in late 2024.
Yes, that was another significant signal.
What does that tell us? Usually buybacks suggest a company thinks its stock is undervalued, right? But for a company in such a capital-intensive growth phase,
It does suggest they felt the market wasn't fully appreciating their value at that time, yes. But it also signals a shift, maybe, from just pure relentless growth towards creating more direct shareholder value. They had the balance sheet strength to do it, and it was a way to return capital and show confidence. It's definitely a sign of maturation for a company in this sector.
and this ties into their capital deployment effectiveness. The sources flag a strong return on invested capital, ROIC.
Exactly. The ROIC was reported at 22.37%. That's a very healthy number. It indicates that the capital they have been deploying, primarily into building out their mining infrastructure, has been generating strong returns for the business. That buyback complements this, showing they consider stock valuation alongside internal investment opportunities.
All right, let's get into the numbers. Chapter 3, Financial Analysis. Market cap around $5.33 billion as of our snapshot date. And the revenue growth story is, well, pretty explosive on the surface. From about $39 million in fiscal 2021 up to nearly $379 million in fiscal 2024. That's huge growth.
It really is hyper-growth territory, but you have to look deeper than just the top line. If you look at their historical income statements, through 2024, you generally see negative operating income and negative net income.
Right, so growing fast, but losing money. How does that square?
It reflects that massive investment phase we talked about, building data centers, buying tens of thousands of expensive ASIC machines. That comes with enormous depreciation costs hitting the income statement. It was all about scaling up the infrastructure first.
Okay, but then there's this dramatic swing in Q3 2025. The sources mention a net income profit of $257.4 million. That sounds like they turned a major corner.
Ah, yes. This is where you really have to pay attention to the accounting. That profit isn't purely from mining operations becoming suddenly hyper-profitable.
So what's driving it?
It's heavily influenced by a relatively new accounting rule, FASB ASC 35060. Before this rule, companies holding crypto assets like Bitcoin had to mark them down if the price fell below cost, but they couldn't mark them up until they actually sold them. It created this asymmetry. Now, under ASC 35060, they have to mark their crypto holdings to fair value each reporting period. So remember that huge Bitcoin treasury, over 13,000 BTC. If the price of Bitcoin shot up significantly during Q3 2025.
Then a large chunk of that reported $257 million profit is actually just unrealized gains on the Bitcoin they're holding.
Yeah.
It's a paper profit reflecting the market value change.
Precisely. It's not necessarily cash flowing into the business from selling mined Bitcoin. Investors absolutely need to separate that fair value adjustment from the underlying operational cash flow.
So speaking of cash flow, the picture there looks very different, doesn't it? The sources point to extremely negative free cash flow.
Yes, that's the other side of the coin. Free cash flow in 2024, for example, was negative $1.038 billion, with a B.
Over $1 billion in negative free cash flow. How is that sustainable? Isn't that just burning cash at an alarming rate?
Well, it looks alarming if you think of it as operational losses, but it's not. That negative number is almost entirely driven by capital expenditures, or CapEx. It represents the massive investment in building those data centers and buying those efficient ASICs we discussed. It's the cost of growth, not a sign the core business is failing.
Okay, so it's reinvestment. And they manage this without crippling the balance sheet.
Apparently so. The sources indicate a strong balance sheet overall. low debt-to-equity ratio, around 0.44, and excellent short-term liquidity, with a current ratio of 4.37. That suggests they financed that expansion relatively prudently, likely using equity raises during strong market periods, rather than taking on excessive debt. That's a key differentiator from miners in past cycles who often got over-leveraged.
And what about valuation? How does CLSK stack up?
On a relative basis, looking at the trailing 12-month price-to-earnings ratio, it was somewhere in the 18-20 range around our snapshot date. That actually looked favorable compared to Riot, which was unprofitable on that basis, and somewhat similar to Marathon, which was in the 10-17 PE range.
But trying to pin down an intrinsic value using something like a discounted cash flow model sounds tricky here.
Extremely tricky. The sources emphasize this. Because the company's revenue is so tied to Bitcoin's price, any DCF model is incredibly sensitive to your Bitcoin price assumptions. You have to use a very high discount rate, think high teens, low 20s%, to account for the inherent volatility and risk. And even then, a small tweak in your long-term Bitcoin price forecast can drastically swing the calculated intrinsic value, maybe by 50% or more. It's tough.
Okay, let's shift gears now to part 2. Market Dynamics and Synthesis, Chapter 4, Market Sentiment. So, what's the general feeling about CLSK out there in the market? What are analysts saying?
Overwhelmingly positive, actually. The analyst consensus was a strong buy. Something like 88% of analysts covering the stock recommended either buy or strong buy.
Wow, 88%. That's pretty bullish. Any price targets?
Yeah, the average 12-month price target seemed to be hovering somewhere between $20–$22 per share, reflecting that optimism.
And technically, how did the chart look?
Also, positive momentum signals. The price was trading above both its 50-day and 200-day moving averages, which traders often see as a bullish sign.
Okay, so analysts are bullish, technicals look good, but earlier you mentioned this is a battleground stock. Where's the other side of the argument?
Ah, yes. The counter-narrative is loud and clear in the short interest data. The sources reported short interest at 20.41% of the float.
20% short interest.
Right?
That's quite high, isn't it?
It's very high.
Yeah.
For context, many volatile tech stocks might see short interest in the high single digits or low double digits. Over 20% signifies a really deep fundamental disagreement in the market about the stock's value. This is the data point that absolutely confirms CLSK is a battleground stock. You have a significant portion of the market betting heavily against the company. And it's not just retail shorts, institutions are involved too. JP Morgan, for example, had recently downgraded the stock, specifically citing valuation concerns.
So, a clear divide. Bulls focusing on efficiency and growth, bears focusing on valuation and Bitcoin dependency. That explains the volatility.
Okay, let's look at who owns the stock then. Chapter 5, Ownership Structure. Who holds the shares in this battleground?
Well, institutions have a massive presence. They hold about 61% of the outstanding shares, according to the sources.
61%, that's a lot. Who are the big players?
It's the names you'd expect, the passive giants. BlackRock is the largest holder with around 16%. Then you have the Vanguard Group with about 9%, and State Street Core holding close to 4%.
BlackRock, Vanguard, State Street, the big index fund managers. What does that tell us?
It's really important. It means a significant chunk of CLSK's stock price movement isn't necessarily driven by people actively buying or selling based on CleanSpark specific news or fundamentals. Instead, it's influenced by broader market flows. Money moving into or out of index funds like the Russell 2000 or into sector ETFs focused on blockchain or crypto, where CLSK is a major component.
So the stock can get pushed around by flows that have little to do with the company itself. Exactly. That passive ownership base can amplify volatility or create movements that seem disconnected from the company's day-to-day operations or announcements, something for investors to be aware of.
What about insiders, management and directors? Do they have skin in the game?
They do. The sources indicated executives and directors collectively owned around $115 million worth of stock, which is certainly a meaningful stake. Looking at recent insider transactions, there was some net buying reported. However, a lot of that buying activity seemed to be related to exercising stock options rather than open market purchases. There were also more open market sales than buys, but that's often common, executives selling shares periodically to cover taxes associated with vesting options or for diversification. It wasn't necessarily signaling a lack of confidence, but it wasn't aggressive buying either.
All right, let's pull together the potential pitfalls. Chapter 6, Risk Assessment. The sources usually include a SWOT analysis. Strengths, weaknesses, opportunities, threats. Can we walk through the key points for CLSK?
Sure. Strengths are pretty clear by now. That industry-leading efficiency, the 16.07 JTH figure, and the fact they own their infrastructure, giving them more control.
Weaknesses.
The big one is obviously the extreme dependence on Bitcoin's price, also the history of net losses during the major build-out phase, and just the inherently capital-intensive nature of the business. You constantly need cash for new machines.
Okay, opportunities.
The AI and HPC diversification is huge, leveraging that existing infrastructure for a new revenue stream. Continued institutional adoption of Bitcoin is another potential tailwind, and maybe even monetizing their large power capacity for grid stabilization services in the future.
And finally, the threats.
Number one threat, a prolonged, deep bear market in Bitcoin. That's existential. Future halvings reducing the block reward further. Potential regulatory crackdowns, especially around the energy consumption of mining, that's always a risk. And geopolitical risks, too, like potential tariffs on the ASIC machines, most of which are manufactured overseas.
That dependence on Bitcoin's price seems to loom over everything.
It really does. It's the core risk. We should probably talk about reflexivity here again, because it's so central to understanding miners.
Explain that again. How does reflexivity work in this context?
Reflexivity is this feedback loop where the price of the asset, Bitcoin, directly impacts the company's fundamentals, which then further impacts investor sentiment and the price and so on. When Bitcoin's price is rising, it's a virtuous cycle. CleanSpark's revenue goes up, the value of their Bitcoin treasury balloons, it's easier and cheaper for them to raise capital, debt, or equity for expansion. Investor confidence is high. Everything works in their favor. The rising price improves their business reality.
But the reverse is also true.
Viciously so. When Bitcoin's price falls, the cycle reverses, and it can be brutal. Revenue plummets, the treasury value shrinks, access to capital dries up or becomes prohibitively expensive, layoffs might occur, expansion plans get shelved. The falling price actively damages their business reality. This extreme sensitivity, this feedback loop, is why miners are so volatile. It's much more than just tracking the price of Bitcoin. The price actively shapes their operational and financial health in an exponential way. That's the single greatest risk.
Okay, let's try to bring it all together. Chapter 7, conclusion. So synthesizing everything to the sources, what's the core bull case for CleanSpark at around $19 a share?
The bull case rests on them being a best-in-class operator. They have a proven, durable efficiency advantage that low JTH matters. They have a strong balance sheet compared to peers, giving them resilience. And crucially, they have strategic flexibility with the AI-HPC pivot. So bulls see CLSK as offering leveraged exposure to Bitcoin's potential upside, but managed by a competent team with operational excellence and a path to diversify revenue streams. They're betting on execution and the long-term adoption of Bitcoin.
Makes sense. And the bear case. Why the 20% short interest?
The bear case is simpler and perhaps more powerful in the short term. It's almost entirely about that near total dependence on Bitcoin's price, which is inherently unpredictable and volatile. Bears look at the high valuation relative to fundamental cash-generating earnings power, stripping out those unrealized gains from accounting changes. They see a business model that requires constant, massive capital expenditure just to maintain its hash rate share against rising network difficulty and machine obsolescence. They worry about the next downturn or regulatory headwinds.
So operational excellence, fighting macro dependency. That's the core conflict we started with.
Exactly. The price of $19.31 reflects that tension, with significant optimism baked in, but also significant skepticism lurking.
The path forward for CleanSpark seems almost guaranteed to be volatile, driven by how well their operational strengths can weather the storms caused by Bitcoin's price swings. Okay, here's a final thought for you, something to mull over based on our discussion. We know institutional demand for Bitcoin has been massive. Remember that 7.4 times new supply figure. And we know CleanSpark has this tangible opportunity with AI and HPC using their existing infrastructure. So the provocative question is, how effectively, and maybe more importantly, how quickly, can CleanSpark actually scale up and monetize that physical energy infrastructure for AI HPC? Can that diversification become significant enough, fast enough to genuinely smooth out the wild ride caused by Bitcoin's inevitable price swings? That feels like the real test of whether they can truly evolve into that digital utility we talked about at the start. If you found this deep dive valuable and want more structured analysis like this, do check out Stock Analytics AI.
For just $4.99 a month, you get access to our full playlist. That's 500 deep dive videos covering every single stock in the S&P 500. And coming up next, exclusively for members, we're tackling the NASDAQ 100. Plus, members can request specific stock deep dives. If there's a company you want us to analyze, just drop the ticker symbol in the comment section and we'll get on it.
And just the standard but important reminder. This analysis was generated using an AI system and structured research protocols. It's intended purely for educational and informational purposes. It is absolutely not financial advice. Please always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.